Hello investors and future investors, welcome to the channel. For today's video, I'm going to be showing you the top 3 option strategies that can be used in order for you to grow a small accounts portfolio. Now, I'm going to walk you through a step-by-step of each one of these option strategies, and I'm going to show you how you could implement it in order for you to grow your portfolio. Now, if you're new to options trading or you're trying to use options trading in order to supplement your regular 9 to 5, then you so happen to stumble onto the right video. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors and future investors. My name is Tim, and on this channel, I show you how I use my portfolio in order to make consistent income. For today's video, I'm going to be walking you through 3 of the best option strategies that can be used to grow a small account portfolio. And yes, even if you have a portfolio with just a couple $100s, you can use these strategies to grow your portfolio as well. Now, you guys know how we do it. We like to go ahead and get down and dirty with options. Now, for today's video, the stock of choice is going to be SoFi Technologies, and that ticker is going to be SOFI. Now, the reason I'm going to work with SoFi Technologies is because the cost of entry is trading at $18.12 per share. So anyone with a small account portfolio could actually go ahead and use these option strategies using SoFi. Now, for those of you that know, if you stay to the end of the video, I will give you a bonus, and this is definitely going to work if you only have a couple $100s in your portfolio. So let's go ahead and go down to trade SoFi options to the bottom in order for us to go ahead and open up our options chain. Now, if you're new to options trading or you're new to the channel, this area down here in its entirety is what's known as the options chain. Now, what does the option chain do? The option chain comprises of a lot of information that helps us make a very informed decision depending on whatever contract we want to get into. Now, before I go ahead and give you the step-by-step walkthrough, there's always 2 requirements I have for my viewers and also my subscribers. Requirement number 1 is going to be always make sure to do your own due diligence before investing. What might work for my portfolio, quite frankly, may not work for yours. Requirement number 2, always make sure to have an exit strategy before entering any options trade. That way, if the trade were to go against you, you would know how to get out of that trade. Now, let's go ahead and get into these strategies. First option strategy, we're going to be assuming that you have some cash in your portfolio. So we're going to go ahead to sell, we're going to go ahead to put, and we're going to choose a strike date. Now, ideally, if you're trading with a small accounts portfolio, you want to give yourself enough time while still making some decent money. So we're going to go ahead and we're going to choose a 30-day expiration or the closest strike date to it. And that's going to give us August 1st, and that's going to give us exactly 30 days to expiration. Now, once again, the reason why you want to choose 30 days is because you have a small account portfolio, and your whole purpose of using these option strategies is to grow your account portfolio consistently over time. Now, by giving yourself enough time, you won't have to manage this option strategy very often. So now we have sell, now we have put, and we give ourselves enough time with the strike date. Now we're going to go ahead and choose our strike price. Now, the current share price of SoFi is $18.11. The share price might be fluctuating just a tad because the stock market is still open. Now we're going to go ahead, we're going to choose our strike price. The strike price I will be going with is going to be the $16 strike price. The reason I'm going to choose the $16 strike price is because that gives me a 75% chance of profit. So my criteria for choosing my strike price with this particular option strategy is going to be my chance of profit. Anything for 75% or higher. Now, with the $16 strike price and a 75% chance of profitability, I will be paid. This is a sell option contract. The amount I'm going to be paid is going to be $50 or 50 cents. In the real world, this is going to be 50 cents multiplied by 100 shares, and then that's going to give you $50. Let's go ahead. We're going to click into it. The number 1 option strategy in order for you to grow a small account portfolio consistently is going to be known as the cash secured put. The cash secured put is perfect for growing a small account portfolio because it is known as a win-win option strategy, meaning no matter what you do, you're gonna win. And I'm gonna give you a detailed walkthrough of how you're gonna win with this option strategy. Now, the most important thing that's going to help you grow a small account portfolio is what we call options premium. So, whenever you go ahead and do this option strategy, you're going to be receiving premium. The premium in this case is going to be $50. If you were to do this option strategy every 30 days, you will be receiving $50. One of the criterias for you to do this option strategy is that you would need to leave a collateral. The collateral that you're going to need to leave is always going to be whatever strike price you chose. In this case, $16, and you multiply that by 100 shares because each option contract does contain 100 shares. So your collateral in this case is going to be $1,600. I did mention these option strategies are going to be good for anyone trading with a small account. So if you do have $1,600 in your portfolio, then you could go ahead and do this option strategy. Now, I also mentioned that this option strategy is known as a win-win option strategy. So this is the first way you're going to win. So come expiration date of August 1st, once this share price right here, once it stays above this $16 price here, if it finishes off at any price at 16.5, 17, then you go ahead and you keep this option premium, that $50. Now, whether the trade works in your favor or not so works in your favor, this $50 here is always going to be yours to keep. So, in addition to you getting to keep your $50, you're going to get your collateral of $1,600 that's going to be released back to you. Now, you could choose to go ahead and do this option strategy again on the same stock, or you could go ahead and do the same option strategy using a different stock. Now, why would anyone want to use this option strategy? Well, it's quite simple. The basis of this option strategy is a bullish option strategy. So, whenever you decide to do the cash secured put, you're of the mindset that the share price is going to continue to go up, it's going to trade sideways, or if it does come down, it's not going to come down to the strike price you chose. Now, if you want to own any stock, but in this case, SoFi, you want to own SoFi in your portfolio because you have already done your own due diligence and you decide this is a very good stock for you to hold for the long term. But however, you think the current share price is a bit too much. You could do two things. You could bite the bullet and pay $18 per share for 100 shares, and that's going to run you $1,800. That's one option you could take, and we can explain that more in the next option strategy. Or you could take the options route. The option route is going to allow you to get the share price at a lower cost, and that's if the trade goes against you. I'm going to jump into that in just a second. And in addition to you waiting for this share price to come down to this strike price, you're going to be paid. So that is why anyone would want to do the cash secured put. The cash secured put avoids you having to have your capital tied up by owning 100 shares. You could simply just use your cash as collateral and keep repeating this option strategy. So that was your first win right there. You go ahead, you keep your option premium, you get your collateral released back to you, and you could go ahead and do this trade again. Now, the other way this trade could go, which is your second win, come expiration date of August 1st, if this share price right here so happens to go below your $16 strike price, then once again, this $50 is yours to keep. Remember, that $50 is very essential to growing your small account portfolio. Now, you're going to go ahead and you're going to lose your $1,600 that you left as collateral. But I did say this is a win-win option strategy. So here's your second win. Now that you're going to lose your $1,600 in your portfolio, now you're going to have 100 shares of SoFi because Robinhood is going to take your $1,600 and they're going to buy you 100 shares at a $16 mark. Now, why is this a win? Well, here is why. The first win is that you get to keep your $50. The next win is that you already did your own due diligence and you decided SoFi is a good stock to have in your portfolio. So now you're going to be able to own a good stock you wanted in your portfolio at a much lesser cost. In this case, $16 a share. So in actuality, what happens is that you just save yourself $200. And you did that by, instead of spending $1,800 for 100 shares, you implemented this option strategy and now you are assigned. So in assignment, you only paid $1,600 in order to own 100 shares, saving yourself $200. In addition to that, you were paid $50 while you waited for the share price to go down to $16. hence a win-win option strategy. So that right there, investors and future investors, is the number one options trading strategy that could help you grow a small account portfolio. Now we're gonna go ahead and go to the number two option strategy that's gonna help you grow a small account portfolio. Let's go ahead and clear these parameters. And for this option strategy, we're gonna go to sell, we're gonna go to call. Now, hopefully you guys already can see a commonality with the first option strategy and the second option strategy. They are both sell option strategies. So that means you get money as soon as you execute these strategies. By selling options, it allows you to get money, and that money is going to allow you to grow your options portfolio. Now, we're going to go ahead and choose a strike date, and the strike date we're going to be using is the exact same one, which is going to give us 30 days to expiration. Remember, if you are trading with a small account, you want to give yourself enough time in order for the trade to work in your favor. Now, with this option strategy, we're going to go ahead and we're going to choose our strike price. Now, the strike price I will be choosing is going to be the $21 strike price. Now, my basis, once again, for selecting the $21 strike price is going to be based solely off my chance of profitability. So, if you have a small account portfolio and you're new to options trading, then you're not familiar with the technicals or the fundamentals. One options trick you can use is your chance of profitability. With an 80% chance of profitability, that tells you that there's an 80% chance that this trade is going to go in your favor. So hence, the corresponding strike price for the 80% chance of profitability is the $21 strike price, and that's how we come up with our $21 price. So in addition to your $21 strike price and your 82% chance of profit, you're going to get paid once again. The amount you're going to get paid is going to be 0.59 or $59. Now, this number two option strategy that's going to help you grow your small account is going to be known as the covered call option strategy. Now, the covered call option strategy is a bearish option strategy. The reason why it's a bearish option strategy is that when you do decide to implement this option strategy, you're of the mindset that the share price is going to go down, it's going to trade sideways, or even if it does go up, it's not going to pass your strike price. So there is one main criteria in order for you to do this option strategy, and that is you will have to own 100 shares of the stock. Remember, the previous or the number one option strategy, you do not have to own the stock. You just need to have money in order to leave as collateral. With this covered call option strategy, you will need to own the shares. So I did previously mention how you're going to go ahead and own the shares, and that's going to be by buying 100 shares at the current price. So let's say the current price is at $18. You're going to buy 100 shares. It's going to run you $1,800. Now, let me show you how this trade is going to work. Once again, this second option strategy is also known as a win-win option strategy, meaning no matter how the trade goes, you're going to win. So this is your first win. Come expiration date of August 1st, once this share price here of SoFi is trading below the $21 price, then you're going to get to keep your credit. Remember, that credit is yours to keep no matter how the trade goes. Now, in addition to that, you're going to have your 100 shares released back to you. In order for you to perform the covered call, you're going to need to own 100 shares. Once you decide to execute this option strategy, your 100 shares will be locked away and used as collateral until the trade is over. So you're going to get your $59 and you're going to be able to use your 100 shares as collateral. So it's pretty much like renting your 100 shares. So that's a win for you. Now, the other way this trade could go, or the second way you could win, is that come expiration date once again, if this share price goes up drastically and it does go past your $21 strike price, then here's the most important thing to grow your small account portfolio. You get to keep this option premium right here. Remember, that's extremely important in order for you to continuously keep growing your portfolio. But now you're going to go ahead and you're going to lose your 100 shares. But remember, this is also a win. Because you're going to lose your 100 shares, remember you bought it at $18 per share. Now that you lose it, you're going to be selling it at $21 per share. The difference between the $21 here and the $18 is going to represent $3. Remember, you are dealing with options here. So you're going to multiply that $3 by 100 shares. And now you're going to be getting $300 in addition to your $1,800 that they're going to give you back as your cost that you paid for the shares. Hence, that is your second win. So there you have it, investors and future investors. The number two option strategy in order to help you grow your small account very consistently is going to be the covered call option strategy. Now, here is the number three option strategy. The number three option strategy is going to be a combination of the number one and the number two. And when you put them together, you're going to get what's known as the wheel option strategy. So let me give you a quick demonstration. Let's go back to our previous one, which is our sell put, and the strike price we chose was $16. So let's go ahead. We're going to go ahead and click into it. Now, if this goes against you, which is the cash secured put, and you will assign the shares, you're going to be assigned the shares right now at $16. So you're going to lose your $1,600 that you left for collateral, but now you're going to have 100 shares of SoFi at $1,600. So what you're going to do now is you're going to go ahead and you're going to flip the switch and do the number two best option strategy, and that's going to be the covered call. Remember, you're assigned at $16. So now you're going to go ahead, you're going to flip to the next option strategy, which is the covered call. So we're going to go to sell and call, and this time we're going to be selecting the exact same strike price, which is going to be the $21 strike price. So now you got assigned at $16. But now you go ahead and do the covered call, but now your strike price is at $21. If you do get assigned, or if the trade goes against you, now the profit you're going to be making is now going to be the difference between $16 and $21, which is going to be $5. You multiply your $5 again by 100 shares, and that's going to give you $500 in addition to your $1,600 cost basis that you paid to acquire 100 shares. This new option strategy, like I mentioned, is going to be the wheel option strategy. Now, the wheel option strategy is one of the perfect option strategies if you're trying to grow a small account, and especially if you're new to options. The reason for that is because it's known as a win-win option strategy. No matter how the trade goes, you always end up winning. The only way this trade goes against you is if you choose the wrong stock. And remember, the main point of doing the wheel option strategy, the combination of the cash secured put and the covered call option strategy, is for you to continuously keep generating income. The income you receive, that's what's going to help you grow your small account portfolio consistently and safely over time. Now, I have not forgotten about you guys that are trading with a small account with just a couple $100 in it. So, this is one option strategy that you can do if you're new to options trading. And if you're trading for a very small account, we're going to go ahead and we're going to change the stock right now. And we're going to go to the Spider ETF. The ticker symbol is going to be SPY. So now that we have SPY open, we're going to go ahead once again and go to Trade SPY Options down to the bottom here. And that once again is going to open up the option chain. Now, this new option strategy is going to be a two-leg option strategy. So pay very close attention, because if you are new to options and you're trading with a small account, you need to get these steps correct. So what you're going to do now, you're going to practice the first option strategy, which we did, which was the cash secured put. We're going to go to sell, we're going to go to put, and now we're going to choose our strike date. We're going to choose July 9th, which gives us 7 days to expiration. Now, for this option strategy in particular, you only want to give yourself 7 days, not a month like the previous one. The reason why you want to give yourself 7 days is because you're trading with a small account. You do not want your collateral to be tied up. If you do have a bigger account portfolio, then go ahead and choose 30 days or 45 days would be the best. So now you have sell and you have put, you have 7 days to expiration. Now you're going to go ahead and choose your strike price. Using the same basis we used before, you're going to be starting off with a 75% chance of profit or higher. So that's going to coincide with the 615 price right here. We're going to go ahead, we're going to select that. Now we're going to go ahead and we're going to change the parameters to the top. We're now going to go to buy. We're going to maintain put and we're going to maintain the exact same strike date. Now we're going to choose the strike price right below. So that's going to give us the 614 strike price. Let's go ahead and we're going to select that one. This option strategy is going to be known as the put credit spread. The put credit spread is a bullish option strategy and is perfect for anyone trading with a small account or if you're new to options. The reason for that is quite similar to the previous one. The number one reason is that as soon as you do this option strategy, you're going to get paid. The amount of money you're going to get paid is going to be $23.92, or let's round it up to $24. Now, the criteria for you to do this option strategy is going to be that you need to leave a collateral. The collateral in this case is going to be $100. That's why this option strategy is perfect if you only have a couple $100 in your portfolio. So you can do the first two option strategies or the first three option strategies rather, then you could consider this option strategy, which has a very low barrier to entry. Now, here's the kicker for this option strategy, which is the put credit spread. By doing this option strategy, your returns is a lot higher than the previous ones. I'm not sure if you noticed, but your returns for the previous three option strategy ranges around 3%. With the put credit spread, you have an opportunity to make around 24% per every time you do this option strategy. Now, if you're trading with a small account portfolio, you have to be extremely careful. As simplistic as this option strategy look, please do not over leverage yourself. Stick to one contract until you master it, and then maybe you could consider scaling. Now, the way this trade could go against you is a bit different to the previous three option strategies because this one is known as a defined risk option strategy. The first three are known as win-win option strategy. This one is a defined strategy. And the reason for that is that there's a certain amount that you could lose. In this case, the amount that you can lose is going to be your $100 collateral. That's your gross you could lose. But to give you a bit more detail, the actual amount you're going to lose is going to be whatever you receive as your premium, which in this case is going to be $24. You're going to subtract that from the amount of money you leave for collateral, which is going to be the $100. And your net loss on this trade, if it goes against you, is going to be $86. So there you have it, investors and future investors. If you're trading with an account portfolio with just a couple of $100, then the put credit spread might be the way for you. If you guys have any issues, feel free to replay this video and make sure you get it right. You do not want to make the mistake with this and end up with a completely different option strategy. Here's a simple way to tell. If it does not say put credit spread, then you're doing it wrong. Now, if you guys have any questions about the top three best option strategies in order for you to grow a small account, which is going to be the cash secured put, the covered call option strategy, the wheel option strategy, then let me know in the comments below. If you guys want me to dive deeper into the put credit spread, then go ahead and check out the video or two videos, I believe, right before this one. Is going to give you a detailed walkthrough of the put credit spread. Now, for those of you guys that made it to the end of this video, you guys are the real investors and future investors. I want to thank you guys for always supporting the channel. And now would be a good time for you to go ahead and like the video. Subscribe to the channel. Make sure to hit that notification bell to get an alert whenever I post a video. But here's the most important thing. The reason why I make these videos is because I want to help as many people as I can get away from that 9 to 5 by making income with options trading. So if you know anyone like that that's struggling to grow a small account portfolio, the right thing to do is to go ahead and share this video with them. Let's help as many as we can. Now, until the next video, keep pushing your investments.